Hey, how's it going, everyone? Dennis here, and today we're going to take a look at my portfolio and see some of the things that are going on with it, how it's been performing over the last little while, and possibly some changes that might be coming about. So this is my portfolio right here, nicely named it Dividend Dennis, although the dividends should be really like growth dividends on here, just because we focus on the dividends going up more so than the dividends today. Our current portfolio sits at $71,094. So for our all-time right now, we are actually up still about $8,600, 946 of which has been dividends so far, which is really, really nice. Now, if you're somebody new to the channel, this is M1 Finance. This is what I personally love to use when it comes to managing my long-term investing portfolio. If you guys are interested in checking it out, I'll always have a link for you in the show notes. They do have a nice sign-up bonus for people using my link, and it helps support out the channel, so I get to do more stuff like this for you guys. So let's go ahead and take a look and see how the portfolio has kind of performed over the last little while. Now, if you're somebody who's like, whoa, this number is massive, right? 71,000. Well, keep in mind that I actually started this account with about $100 3 years and, like a quarter ago. And I just kind of invested as I was going along slowly and surely, and then, started adding more as I got more comfortable and, really understood like where I kind of want to take this portfolio. But let's kind of break this down a little bit. Let's see how we're doing. For the last year, we're actually still up about $2,600. The quarter is where it starts getting a little funky with the numbers here, right? You can see we're down about $3,000. $186 though was earned in dividends, so that's really nice. For those that might be wondering, this is a money weighted return, so that's why the percentages might be a little different than you see on other portfolios. In the holdings tab, you can actually see the overall unrealized gains. You can see here in the last month, we've been doing really well. We're up about almost $5,800. We still were investing while the market was down. That's a really critical point that I like to make aware for people that are watching, is that when the market is down, I am still buying. I actually like to buy during the dips more than when the market is going up at a very substantial rate in a very short amount of time. So you can see here the week is down. We're about $1,700 down. You can see we actually did a pretty big purchase over the last week because the market was going down. And I typically buy in the stocks that I'm holding that are at their lowest point, because if I still believe in these companies and their fundamentals, I want to be buying them at the best price possible. Now, I usually go to seekingalpha.com for this information to kind of gauge, where all of my holdings are sitting at. I have 19 holdings here in the portfolio. And so what they have is this 52-week range. Now, there's a lot of other factors that go into this, whether it's looking at like the balance sheet or a lot of different pieces of data that you can gauge where, you should be putting your money into. So the thing I do like to look at is like, okay, for example, Ally is at its 52-week low. Facebook is really close to its 52-week low. Home Depot is down there as well. So then I start looking at these companies and saying like, are these the ones that I want to be diving in a little bit deeper with? So when I look into them, so like for example, this is Home Depot. I always like to make sure everything's on screen. So if I go to like their financials, you can look at their income statement. I like switching this from left to right. So right now it's on the annual, so you can see all of that revenue growth that's been happening from January 2018, or from 2018 all the way to 2022 so far. You can see all those. All that growth that comes in from that revenue. You can look at all the information to see, is this company still worth having in my investment? And if it is, why not buy? Let's go to the summary here. Why not buy when it's so close to its 52-week low? Because if I still see the company as valuable when it was, at what is the highest point, 420? If I still see the value in it at 420, why not buy it at 293 or whatever the price point is, like 304 right now? So the PE ratio right now is 18. So that's actually, almost 19. So that is still pretty solid. You can see the EPS is 16.12, which is really great as well. So these are kind of the factors that I look into. I look at the cash flow, see where it's coming as far as cash flow goes. Let's actually go quarterly for the cash flow here. I like to look at that quarterly. So you can see all of this as well too, and see, okay, there's a little bit of a downtrend right there, and kind of considering, where they were a year ago, but they're still up from a year ago. So, you got to look at these different factors. You got to look at their debts as well. And then I like to look at, it's not on, it's on the balance sheet. I like to look at their outstanding shares as well and see essentially what is going on, if they're going up or if they are going down. So you can see here that is definitely downward, which is great. and then you can see all this other information. So I take into account, I do also a thing where I do like to look at the number of employees companies have on staff. Obviously, it's not a big metric. I don't think a lot of people ever talk about it, but I like to kind of pay attention to this because payroll is probably one of the most expensive things that companies have on just entirely on their profit and loss statements. And so you can see here, right now, as of January 2022, there's almost 500,000 employees where, a couple of years ago, they were sitting at 413,000. So you could also see a year prior to that, they actually had a little over 500,000. So they actually dropped a pretty significant amount of employees over just the last year from here too. So those are things I like to consider as well too, because obviously if a company can afford to be paying, more and more employees and hiring more people, that's also a good thing to look at as well. And then let me switch those from left to right. And then, of course, you could just look at all the other things that come along with it. Now, if you don't really look at, the income statements, which is like the profit and loss, the balance sheet, or the cash flow, it is definitely a great thing to kind of go through the process of learning more and more about these things, because that can help determine if the company is still worth investing into for the long term. Obviously, if you're doing a quick synopsis, you can look at that EPS and the PE ratios as well. So as that goes, when we're looking at this portfolio and kind of deciding, okay, well, because we know that our Home Depot stock is down, is that going to be something worth purchasing more of at the time? So if we go into our all-time, I'm going to go into Home Depot by itself, we're actually positive $5.34, and that's all thanks to the earned dividends that we've gotten so far. And you can see here, if it wasn't for the earned dividends, we'd actually be down on this holding so far. We have about 18.63 shares. Average share price 309, and it's currently at 304. So if I actually purchase more right now, I'm actually lowering my my average share price, which is dollar cost averaging. So that's going to go down. Obviously, buying a whole share right now is probably going to change this very, very small amount because we have so many shares currently. But nonetheless, we're buying at a better price point than we have been already, which is kind of a great way to look at it. And just kind of things to kind of consider in that regard. So Home Depot is definitely something that I'm going to be buying more of. And then again, if I look at some of these other companies like Square, I'm currently pretty down on, or Square in the 52 weeks is down, and so is my portfolio. And then kind of on the opposite spectrum, just to kind of get some light to it, companies like Lockheed Martin and Costco right now are pretty much at their 52-week high. So they are flying high. And so those are sometimes the companies that I want to steer clear of for a little bit if I feel like the valuation has kind of had this huge run for multiple reasons. Maybe the company is, showing great numbers, or maybe people are just, flooding money into those. So those are things we have to consider. So as an example, with Costco, we have 7.64 shares. Average price point right now is $4.24, and you can see that the current price is $5.90. I think, I don't know if I was looking at Costco. Let's go ahead and jump over here. Yeah, I wasn't looking at it recently, but you can kind of go through here. They just raised their dividend almost 14% to 90 cents a share. So if you actually own some Home Depot, you're sitting real pretty. You can look at their estimates and see where they're kind of looking to grow. So, they still definitely have a lot of value. Their PE ratio is definitely really rich right now. Obviously, their earnings per share is doing really solid. But again, you can look at a lot of different things here. Let's go to cash flow. And just kind of get an idea of, how everything is doing long term. And if you're like, it's still worth it even at its 52-week high, go for it, right? That's definitely going to be up to you if that's something that looks great. But for me, I'm like, there's a good chance Costco might come down at some point, and then I can buy them at a little bit of a better price point. Or if they just keep going up consistently, eventually I might start buying more back into them. But for now, I'm going to hold off on Costco, but purchase more of Home Depot. Again, those 52-week highs and lows really kind of help me gauge which companies that I already have put in time and focus into to really dig a little bit deeper into and see if, one, like I said, if they're worth holding on to, or two, if they're actually even just worth buying more into as well. Because when they're at their lowest, should I just be buying more? Because we always get that really weird sentiment months down the road after a company has done really, really well after a short period of time to be like, damn, I wish I bought more. And Lockheed Martin's a great example of something like that too, where So I have about 6 shares of Lockheed Martin, average price point of 358, and over the last couple of months with everything going on, you can see this price point has definitely jumped up. And so for a lot of people, they're like, oh man, if only I had bought more on that dip, when it was going on, down this time period right over here, they wish they could have. And for me too, I obviously wish I could have bought more. And I bought, honestly, I think as much as I would have liked to during that time period, because if you look, my last purchase was March 25th. Actually, that wasn't even a purchase. That was a dividend. My last purchase was February 22nd for $22. And so it's been a while since I purchased them because of that price point just going up so quickly in such a short period of time. But when they were down, and I looked at their fundamentals and everything else that was going on with them, I was like, you know what? I still believe in this company. This is a company I want to be invested in. And you can see, they're not big amounts, right? They're small dollar amounts, but I was buying in week after week because the price point was at such a good value for me that I wanted to get it as much as I could. And obviously, if I know now if I knew then what I know now, I would throw more money into it, knowing that, hey, the price point's going to go up, not necessarily down more. So you could even see down here was a little bit more purchasing as well too. So just kind of things to keep in consideration going through that process. Real quick, before we actually continue on with more of this content, because I do want to show you some other things on here, I do want to quickly mention, if you're somebody with student loans, check out refinancing your student loans if you got some pretty high rates. Student loan refinancing is entirely free. Actually takes you about 2 minutes to see what your potential rates would be. I'll have a link for them in the show notes down below with Earnest. If you actually use that link, it helps support out the channel, but you get a nice bonus if you end up refinancing. And here's the cool thing. All that extra money that you save from refinancing, you could possibly reinvest that money into stocks or, do whatever else you want with your money. But let's kind of keep talking about some of this stuff too, because what I ended up doing was I've had some changes in the portfolio kind of on its own based off of how I've been investing and how the market's kind of been shifting. So if you actually go past like some older videos, you'll notice that right now, retail's actually at the very top when it's typically between growth and tech that are number one as far as overall value, because that's how these are kind of shifted in place, is based off of their current values. So I actually had to change out some of my percentages here from my actuals, which are the bottom numbers here. So I changed some of these out a little bit just because how the market has been changing and shifting, and then also my mentality of like what I actually want from this portfolio. So what I try to do is realize, okay, so retail's been going up quite a bit. So I actually don't know if I really want that to be at 21%, because is that going to be too much of the portfolio tied up into retail, which I only have those 3 stocks in the retail, and I do believe in them long term. So I'm not really worried about them not performing well in the short term. So that doesn't really matter to me. But do I want to give them more money now in this slice versus going more into growth or tech, which has in the long term, because I think we're still in our all-time right now. In the long term, tech has gone up probably the most, and then growth has gone up pretty substantially, but because of the markets dropping, it's actually taken some of the biggest hits in the last little while in comparison to a lot of the other slices, so it's more volatile. But that means when it goes down more, there's a better opportunity for it to go up more than a lot of the other stocks I have as well too. So there's like that balance of like, do I want a lot of that growth, and am I okay with a lot more negative? Let me see if let's go actually to the quarter. That was negative, yeah. So you can see here, percentage-wise, this section here has taken some of the biggest hits, right? 10%, down $1,700. Now, finance has also kind of taken a hit as well, but it is relatively a smaller portion of my portfolio. So things that I got to consider, things I have to look at. I actually recently dropped finance to 10% of my portfolio and real estate from 12% down to 10%. So both of these are going to become less significant in the overall thing, even though it's actually real estate has been a little bit more stable in my portfolio, funny enough. But I'm actually keeping these a little bit lower because I do want more going into the growth funds. Actually, let's go in here and take a quick look. So in my growth fund here, I have Tesla, Google, Amazon, and Facebook. And you can see with the last quarter, like every single one of these has taken some pretty massive hits. Obviously, Facebook had taken the biggest one overall when it comes to percentages. But these are companies that I believe in the long term. And yes, they don't pay dividends now. But either one, they will be paying dividends in the future because companies can do that over time. Google is definitely set up for something like that if they wanted to, or if they don't end up paying out those dividends, I can always sell those stocks in about 14 years when I want those dividends to buy into companies that are paying 4 or 5% at that given time. So I have a lot of leeway, and other channels on YouTube and whatnot are doing different things. So I'm kind of going this path, and you can make sure you hit that subscribe button down below to see the progress as we keep going through this, because I think it's interesting to see different perspectives and like different ways that people are planning for their investments and their future, and kind of how that's going to play out long term, right? Because in the short term, you can look at somebody's portfolios like this, right? We're down $1,000 in Apple and Microsoft, and you can be like, oh, he picked some loser stocks right there for that time period. But when we go to the all-time, we're actually up $3,000, almost 76% on money-weighted returns. And you can see here, Apple has been such a great stock. Microsoft has also done relatively well across the board too. So, short-term, sometimes things might look like bad plays, but long-term, they can actually play out very, very well for us. So that's a path that I want to make sure that I'm focusing in on when it comes to this. So as far as like changes, like I said, I am definitely looking at adding a little bit more onto the growth side of things, even though they are going to hurt me on the dividend side of things. And I'll actually go to my dividend calculator here. Let me make sure. Most of this is still on screen. So this is my dividend calculator. And just to kind of give you an idea, I keep track of like how much I'm growing in my dividends every month, as well as, compare them to the year prior, or the month relative to the last quarter. So like, March compared to December, because those companies pay out. So if I focus a lot more on some of those growth companies, that might hurt my dividend growth over time, or in the short term, but in the long term, those might play out much, much better for me. Like I said, because if these companies eventually pay out dividends, that could be helpful. So I'm going to go to Google as an example. Let me open this up. So they don't pay a dividend for sure, but they do, stock buybacks, which is great as well. But let's say hypothetically they did. This is an example here. Is if they did pay out a dividend, let's say they do, half of the average, which is like around 30%. That would be $34.67 per share that you own, which is a 1.36% dividend payout, or a yield, which is great. That's awesome. That would be really cool. Is that ever going to happen? I have no idea. Most people probably have no idea if that's going to happen, but at one point, Apple wasn't paying out dividends as well. So if you keep that in mind, Apple, how many years ago? I think it was 2012 is when they started paying out their dividends. Let's go back in time here. So if you look here, it was around, 2012 is when they started paying out a dividend. So, anytime before that, you were buying in for the growth. And the crazy thing is, it's still a growth company. So can you imagine having purchased stocks around this time period without the intent of earning dividends? And then all of a sudden they're starting to pay out this obviously relatively small dividend, but because you were buying it at such a cheaper price point, potentially, obviously maybe not around this time, but at a cheaper price point, then you are getting these dividends on top of the value going up. So those are kind of some of the things that we're looking at and kind of playing out with this portfolio, because we're going to kind of go our own path, right? Like I've seen a lot of different, channels and everything do different things with their portfolios, and some of them really focus on a good yield now. Some of them, like myself, are focusing in on dividend growth based off of percentages, like we talked about with Costco. They just recently raised their dividend almost 14%. So you get 11 extra cents per share that you have of the company. And so that's going to also help those people as well too, which is, of course, we have Costco. So, but when I'm putting so much money into companies that are not paying any dividends for the pretty much foreseeable future, that could be detrimental to the dividend side of things, but could also be very beneficial to the overall growth of the overall growth of the portfolio. So over the next couple of weeks, I'll probably be changing a little bit of this portfolio out so we can kind of, I don't want to say clean it up a little bit, but change it up just a tiny bit on that front. But overall, what's really cool is if you want to see like my weekly buys, or anytime I buy or sell anything, I'll also have that membership if you guys want to join in, so you guys can see those happening in real time. Plus, you can also email me to get this as well, emailed to you if you end up becoming a member at a certain tier. And then you guys can go from there. But make sure you hit that like button down below, because that does help out the channel immensely. And then I'm going to actually put up another video right over here for you so you can keep on watching and learning. My name is Dennis, and I'll see you in that next video.